Good morning, guys. It is Tuesday the 16th. I spent last week, I was in Missouri at my place out there working on the place. There's two different places I've got out there. This was a partnership. We've got quite a bit of land out there. We're setting up. It's kind of our hunting spot. We got it at a really phenomenal price, but we had to set up all our blinds, and there was some heavy equipment that was left from the previous owners. We had to move. It was a lot more work than we thought it would be, but we got a lot done. So just people coming together, getting things done. And because of where we're at, my signal was complete crap. I couldn't get anything done on Friday that I wanted to do. The internet was down at my office out there, just problem after problem after problem. So unfortunately, I didn't get anything out to you. But I got a little bit of data to throw at you today that I think would be good to know, because a lot of people are worried about the housing market and what's going to happen. There's a lot of stress coming in that I'm hearing in people's voices, and at least in the conversations about, is this a repeat of 2008? Are we going to experience what we experienced there? I personally don't believe so. From what I experienced going into 2008, and I shared with you the last video, right, of course, what I went through personally, but then looking at the dynamics of happening in the market, those things aren't still adding up. The people getting homes that didn't really qualify for homes was not something that we see happening like we did then. The other was the enormous amount of building that was going on. The extreme amount of supply versus demand was way different than what we're dealing with today. So some key points that I read today, right? 44% of homes were sold in bidding wars during July, right? That's 3.5 offers per home in July is what we saw. Now, it's lower than the peak we got in January, which is 70% of homes, but it's still very, very, very strong. Going back to 2009, they commented on there's only 10% of homes in bidding wars. So one of the things that we need to take a look at this from the angle of, people are thinking, oh boy, things are softening. How are they softening? We're not having massive bidding wars. What we are seeing, though, is that many houses are still moving, and moving very quickly, quite quickly, if it's priced right. The difference we have now versus what we had when the rates were very, very artificially low is you had what they called additional buying power, basically, because of these lower rates, right? More affordability is what they call that. But how much more affordable was it? If you had more people that had more capability to buy houses because rates are much lower, therefore they could qualify for a much higher payment, they started bidding on higher priced houses and pushing those prices up. And with the prices going up, they were really sucking up the difference that they made in having a lower rate. So with the price of the home going higher, the rate didn't make as much difference as it did if the home stayed the same. See what I'm saying? So with that being the case, now we're having to bring the prices of the homes down to meet where the demand capability is because of interest rates coming up, where we're going to get that affordability back in line, it seems, and there's still going to be a high demand. We also have a demand for rentals. The rents have been going up 13+% year over year still. That's a very, very good thing for the real estate investor. We are creating more and more renters. So that's another reason why I don't think that we're going to have the type of housing outcome that we had before. The other thing that we want to look at is new construction starts. Those are down. In fact, July the primary residence type, or the single families was down significantly. So that is telling us that the supply shrinking, right, is going to continue to keep the demand higher. You're not going to have this oversupply coming that's going to push all the other existing home values down because there's too much available. So that's also hopefully would help the supply chain issues, right? We're not having all that supply being sucked up by all those builders that are working. So a lot of things I think they're going to work in favor of the economy and the housing market. Now let's take a look at the charts here. I'm going to do a little bit more of a deeper explanation on some of this information, hopefully to help the scenario here for everybody, because I know some people ask questions with respect to the mortgage-backed securities and how to understand them better. So that's what I'll be able to do, is give you a little bit better understanding of it. So what we have here, I've redrawn the channels that we're in. Right now, 101.25-ish is about where we have our ceiling. That's where our technical ceiling is, where there would be some sell orders, more or less, from bond traders. And then we have what we're seeing as our floor would be the spot where there would be some buy orders come in. Now, there could be news that comes out that forces things differently, right? If we're talking about the way inflation acts, the way other things happen in the market, those could push past those technical levels and cause them to sell more or buy more because of what's happening in the economy and what news is coming out. But what we want to look at is the comparison between yesterday and today. That's what I focus on right now. If we look at yesterday, this was a candle, it was a positive trading day. We started here. We got lower, but we went up and we traded as high as the ceiling. See how we hit that ceiling? And then we traded off of that down toward, it ended about 101.20. That was where the price level where this particular bond finished out yesterday. Well, today we're at 101.95. So what does that mean? Because right now we opened this morning at 101.13. It's like 101.13, went up to that 101, probably 18, 17 level. And now we're down to 101.95. So I pulled my calculator up here just so we can talk about this. We're, like I was saying, peaked out at 101.19. So we're going to take that number. We're going to subtract out where we are today at 100.95. And we're going to get a difference of 24 basis points. What does that mean to you? That means whatever interest rate we were able to get you yesterday, and there was points involved, there has been, just get that settled into your mind. And I'll talk about that in a second. Now, today, it's going to cost 0.25% more in points for that exact same rate, or you're going to have to raise the rate up to try and offset it. That's what that means when these trade lower like that. If it trades higher like this one here, where this one traded 2 days ago, we're at 101.03, and then we went to 101.17. So as you can see here, that right there would probably have yielded maybe somewhere between 0.125 and 0.25% difference in cost. Probably just an eighth. They wouldn't give you that extra. So you'd have saved 0.1% in the cost from one day to the next. That's basically what that means. So when it comes to the interest rates themselves, and it comes to the cost for those rates, we're seeing a lot of points. These points are being charged not by us. This is being charged by the market. Remember, we talk a lot about inflation. We talk about whoever puts that money up for you is going to get paid back over 30 years. But the dollar's value is declining so rapidly over that 30 years, they're not making the money back. They're losing money on you. So right now, if you look at the banking industry, we've talked about this as well, is that they are marking you in a way to get you to refinance every 4 or 5 years. So if that's the philosophy, and this, I'm just getting into what I believe is happening out there. For you, that's the thought process of those who are putting capital into these pools, right? And they lend that money to you, and then they get paid a little bit up front. It should make them feel better to put money into the market if they're getting some points back, because otherwise, right, they would not be getting the kind of capital that they would have been getting just over that time period. And they also know the marketing engine of the mortgage industry is going to get you to refinance in that 4 years. If you look at an amortization table, they made a significant amount of money on you, the industry has, during that window of time. So it doesn't bother them to churn you into a new deal, because they're catching some points up front. They churn you into a new deal later. They're making nothing but interest off of you. So it's not hurting them. But if you stretch it out over 30 years, that's where it gets painful. That's why I'm trying to encourage you guys to look at it from that angle. Look at when you're looking at new properties you're going to buy. They may not have awesome cash flow right now, but what does it look like year 2, year 5, year 7, year 10? What does that look like at 3% increases in cash in your rents? And we know they're going up higher than that. But I am asking you to be benevolent. If you're going to be that kind of a landlord, raise it, 4 or 5%, maybe 6 or 7, 3. Don't do this 13, 18, 20 stuff. That's, to me, that's immoral, but that's me. You guys do what you feel is best for your business. I'm here to help. I'm here to encourage you and give you the best information I've got. Hopefully today was helpful. I will get you some more data on Friday.